Welcome to the Deep Dive. We're here to break down the key market reports and earnings calls, giving you the insights that matter right now. Today, we're diving into Sportradar Group AG, ticker SRAD. They just had their Q3 2025 earnings call. They're the big global player in sports data and tech.
Yeah, and this one's really interesting because Sportradar sits right at that, the intersection of sports, media, and betting. So their results give us a real pulse check on the whole regulated betting market's growth. But the market reaction was, well, pretty strange, a big sell-off, even though they raised guidance and announced this huge strategic deal.
Right. Super counterintuitive.
So our mission today is really to figure out why. Why did the stock drop, 8.6% when arguably the core story actually got a lot stronger? Let's unpack that.
Okay, let's start with the numbers that seem to have spooked the market initially. Because the headline figures, they definitely gave the sellers something to point to. Q3 revenue was $292 million. Now that's up 14% year over year, which sounds solid.
It is solid growth.
Yeah.
But it missed the consensus estimate. Fell short by about 9 million. Expectations were clearly running high.
And then there was the EPS number. Non-GAAP EPS came in around 0.07. The street wanted about 0.09.
Yeah, that's a miss of roughly 22%? So you put those two together, the revenue miss, the EPS miss, and bam, heavy selling volume, stock takes a hit.
But, and this is the big but, right, the underlying profitability metrics looked fantastic. What was the good news the market just seemed to ignore?
Well, the core business showed incredible leverage. Adjusted EBITDA, $84.6 million. That's up a massive 29% year over year.
Okay, wow.
And that resulted in a record adjusted EBITDA margin, 29.0%. That's 320 basis points of margin expansion. Pure operational gearing kicking in.
And cash flow, still strong.
Extremely strong. Free cash flow conversion year to date is sitting at 72%. So the business is humming from an operational and cash perspective.
So help me square this circle then. Record adjusted profitability, great cash conversion, but GAAP profit was down. It went from $37 million last year to $22 million this quarter. What happened there?
Yeah, that needs explaining. It's basically accounting noise. It's not the core business faltering. The big difference was foreign exchange. Last year, in Q3, they had this huge tailwind from unrealized FX gains, about $22 million worth.
Ah, okay.
This year, because of FX volatility, that gain just wasn't there. So the comparison makes the GAAP profit look lower, even though the actual operating engine, like we saw with EBITDA, was running much hotter.
Got it. So you strip out that FX noise and the underlying operational strength is clear. That 29% EBITDA growth, what does that tell us about how they're doing with their customers?
It shows they're keeping them and selling them more. The net retention rate is 114%. That means, on average, their top 200 clients spent 14% more than they did last year. It's sticky.
And which parts of the business are driving that growth most?
The big engine this quarter was SCTS, Sports Content, Technology, and Services. That segment grew 31% year over year, hit $59 million. A lot of that was marketing and media services, but interestingly, their integrity services revenue actually doubled. That shows you the growing global demand for compliance, for making sure betting is clean.
And MTS managed trading services. That always seems like a key differentiator for them.
Oh, absolutely. MTS is where their AI and risk management really come into play. Turnover they managed for clients was up 25% year over year. Over the last 12 months, they've managed something like $48 billion in betting turnover for their clients. It's enormous scale.
And they make a good margin doing it. For the clients, I mean.
That's the key metric. They achieve an 11% plus trading margin for those clients using their service. That basically proves their algorithms and risk management are way better than what most bookies can do themselves. That 11% is like a concrete measure of their moat.
Okay, so strong core business, good customer metrics, tech differentiation. That brings us to the big news, the IMG Arena deal. This structure sounds almost too good to be true, getting paid to acquire assets.
Right, it does sound wild. Sportradar pays zero cash up front. Instead, they are set to receive around $225 million over time.
How does that work?
It's a mix of prepayments, working capital adjustments, and future cash flows that come back to Sportradar. Management was really clear. This is designed to be immediately accretive to adjusted EBITDA margin and free cash flow.
So no hidden catches the market might be worried about.
Well, that's always the initial skepticism with unique structures, right? Are there deferred liabilities somewhere?
Yeah.
But based on the call, it seems structured to be genuinely cash positive for SRI from the get-go.
And what did they actually get for this effectively negative price?
They got a big expansion in content rights, data and streaming rights from over 70 new rights holders. Crucially, this bolsters their offering in key sports like soccer, tennis, and basketball.
And how quickly can they plug that into their system?
That's the beauty of it. IMG Arena had a much smaller client base, maybe 90 or 100 clients. Sportradar has around 800. So these new rights, we're talking 38,000 extra data events, 29,000 streaming events. They're now flowing directly into Sportradar's global distribution network, ready for immediate cross-selling to their huge existing client base.
Massive scale advantage. And they put a number on the synergy impact.
They did. They're expecting this deal alone to add another 250 basis points of adjusted EBITDA margin expansion in 2026, just from integrating IMG.
Wow. And alongside this deal, they also boosted their share buyback. Talk about confidence.
Exactly. The board added another $100 million to the repurchase authorization, bringing the total up to $300 million. And they've already been active, buying back $86 million worth of stock at an average price of $17.96. That sends a pretty strong signal about what they think the shares are worth.
Okay, beyond the financials in the deal, they also talked about AI and product innovation. This feels like where the long-term moat really gets built.
Yeah, this was fascinating. They're moving way beyond just being a data pipe. They mentioned new features for their NBA Foresight streaming, but the really groundbreaking stuff is this generative foundation model they built for basketball.
A foundation model, like the big AI companies are building?
Kind of, yeah, but hyper-specialized.
Yeah.
It's trained on billions of 3D body pose data points data that only they have from tracking players on the court.
Billions of 3D data points. What does that actually let them do, or let their clients do?
For betting operators, it means they can start pricing really complex, high-margin bets that were impossible before. Think about bets based on player momentum, team shape, specific movements, stuff you can only model accurately with that kind of granular 3D data. It locks SRAD in.
So it creates new betting markets only they can service?
Essentially, yes. For those really sophisticated, in-play, non-linear type bets. And for the leagues themselves, it powers next-level coaching analytics and media visuals, quantifying player actions in real time. It's a big leap.
Okay, so innovation pipeline looks strong. Let's circle back to guidance. They raised their outlook for 2025 and gave a peek at 2026 again, something the market seemed to ignore on the day.
Totally ignored it, seemed like. They bumped up 2025 guidance, now expecting revenue of at least $1.29 billion, that's minimum 17% growth, and more importantly, adjusted EBITDA now guided to at least $290 million. That's 30% plus growth, implying almost 240 basis points of margin expansion for the full year. Pretty strong finish expected.
And the early look at 2026.
Even more bullish. They're projecting revenue growth accelerates into the 23% to 25% range on a constant currency basis.
Driven by that IMG deal flowing through.
Exactly. The full impact of those synergies hits in 2026. It just shows management's confidence that this Q3 noise is transient and the underlying growth trajectory is actually getting steeper.
Makes the sell-off look even stranger in that context. Let's touch on regulation quickly. They mentioned the U.S. prediction market situation. How do they see that playing out as a threat?
They seem pretty measured. They pointed out that historically, things like betting exchanges, think Betfair, have only ever captured a small slice, like single-digit percent, of the total global betting pie, the GGR. So they view prediction markets more as maybe a complementary product if a clear regulatory framework emerges, not necessarily a direct threat to their core data business.
But they did see a potential silver lining, right, in terms of pushing regulation forward.
That's the interesting angle.
Yeah.
Having these prediction markets pop up, especially in big states that don't have legal sports betting yet, like California or Texas.
Right.
Management thinks that could actually speed up the conversation about legalizing traditional sports betting in those huge markets, which would obviously be a massive tailwind for Sportradar, kind of an unintended catalyst.
Before we get to the trade idea, one last thing. Integrity. How do they make sure their data isn't feeding unlicensed or gray markets? It's a critical question for them.
Yeah, they detail their process. It's like a 4-level compliance check. First, they only contract with operators who are licensed, and those contracts restrict data used to licensed territories. Then there's due diligence on the operator, an internal audit function hunting for any IP misuse. And finally, for premium league data like NBA or NHL, they have to follow the league's own strict vetting processes for every single operator getting that feed. Seems pretty robust.
Okay, solid overview. That sets the stage perfectly for our next segment. This is not financial advice. Time for an outrageous but plausible trade idea based on everything we've just discussed.
All right, so the setup is this. The market slammed the stock 8.6% because of basically an FX-driven earnings miss and maybe slightly too high expectations. It completely ignored the fact that the company just significantly upgraded its content portfolio with IMG, raised guidance, projected accelerating growth for 2026, and boosted its buyback. That feels like an overreaction, a valuation anomaly.
So how do you structure a trade to potentially take advantage of that disconnect, especially knowing the company itself is buying back shares around, what, $18?
Okay, so here's the idea. We use that buyback price as a sort of psychological anchor. The company has put $86 million to work at an average of $17.96. They've now got authorization for $300 million total. The trade structure could be a buy right using cash-secured puts. You'd look to sell put options with a strike price maybe slightly above that average buyback level, say the $19 or maybe $20 strike puts expiring in the near term.
Okay, walk us through selling a cash-secured put. What does that achieve?
Right. When you sell a put, you collect a premium up front instantly. That premium income effectively lowers your break-even price if the stock does fall and you end up buying the shares at the strike price. It's cash secured because you need to have the cash set aside to actually buy the stock if it gets assigned to you.
So you're betting the stock probably won't fall much below, say, $18 because the company's own buyback is there.
Exactly. You're betting that the combination of the strong underlying story and that $300 million buyback authorization creates a pretty firm floor, not too far below the current price, maybe around that $18 mark. You collect premium from the elevated volatility caused by the earnings reaction. If the stock stays above your strike price, you just keep the premium nice income. If it falls below and you get assigned the shares, you've bought them at an effective price below the strike because of the premium received, potentially close to management's own average purchase price, ready to ride the accelerating 2026 growth story.
It's a way to get paid to wait, essentially, and potentially get long the stock at an attractive level, using the company's own actions as a guide. Interesting structure. So, final thoughts. What's the key takeaway from this Q3 deep dive?
For me, it's that the market got distracted by short-term noise. This quarter was fundamentally about Sportradar swapping a temporary non-core FX accounting issue for a permanent strategic upgrade. They got bigger, stronger content-wise with IMG, their margins are expanding, cash flow is great, and the 2026 outlook is accelerating. The core investment thesis that they are the essential infrastructure for global sports betting just got stronger despite the stock price dip.
Yeah, that makes sense. My final thought for you, our listener, to chew on is this. Think about that combination. The massive content library post-IMG, plus that proprietary generative AI they're building using unique 3D body pose data. Is Sportradar evolving beyond just being a data provider? Are they actually becoming the fundamental operating system, the high-moat infrastructure that the entire global sports ecosystem, betting, media, teams will run on? Something to consider. Thanks for joining us on this deep dive. We'll get you next time.